Hey folks, House from GNAT News. Today we're in studio. We're with one of my favorite friends, Todd Walker. He's an investment advisor with Greenvest. And what have you got today?
Well, today is sort of fun time because we've been talking a lot about individual securities and asset allocation over the previous months. And this one is it started off with the Secure Act, which just passed. There's a lot of tax breaks and things there. And then I realized there's a bunch of tax breaks that I want to talk about. They're sort of my favorites, or at least at the moment. And these are for 2020.
Tax breaks for 2020.
Tax breaks for 2020.
It sounds good.
And I have to say that I'm not an accountant, so you need to talk to your accountant about all these. We're financial advisors. We manage money. But I just, anything my clients can gain from, I'm always interested in, so I just thought I'd pass along. And it starts with the Secure Act, which, as I said, was a catalyst to this, which was passed 3 or 4 weeks ago. And this got many parts to it, but I'm going to stay with the parts that I think are most beneficial for the average person versus technical about changes in 401k plans and all that.
Gotcha.
So the first thing I'm going to go rapid fire. I'm going to read the idea, and then I'm going to give a little bit of idea of what the benefit is, because we don't want to go too long for this segment. And there's a lot more to a lot of these things, but again, talk to your accountant, but at least you'll know about them. One thing is that everyone knows pretty much that when you get to a certain age with an IRA or a 401k account, you're forced to start taking what's called required minimum distributions.
Right, those
you have to take them. They're your money, but you have to declare it as income.
Got it.
One thing the Secure Act does is it delayed that time from 70 and a half. The rule used to be 70 and a half. That you had to age 70 and a half, you had to start taking the money out. That's delayed it to 72. Now that's not that big a deal, but it does allow your money to accumulate a little bit more. It's a year and a half, and I wanted to mention it because it is something you've really got to be aware of about RMDs, because RMDs, if you don't take out the money the way you're supposed to, have got the highest IRS penalty of all, which is what you don't take out, they give you a penalty of 50% of that.
So they're really serious.
They're really serious. They typically waive the first few times you make the mistake because they're dealing with older people. But anyway, you want to be sure. So it's no longer 70 and a half, 72 starting in 2020. So that's one thing. More important for a financial impact is that IRAs now, just IRAs, with traditional IRAs, you were also prohibited in the past from contributing any money and taking a deduction after years 70 and a half, right? Because
it's all over.
It would be conflicting with the RMDs, right? You're putting it in, you have to take it out. But they have decided to actually allow now people to, if they have earned income, you have to have some kind of earned income, not passive income. But if you have earned income, you can continue to contribute to an IRA indefinitely. You can just continue at past age 70 and a half. So that gives a longer time for you to contribute. And the reason they did both these things, both the age 72 and now this continue to invest, is because people are working longer. So there are actually people who are making sizable incomes into 72, 75, whatever, and they wanted to continue to invest in their IRA. And so this is an important benefit, and actually has some interesting tax benefits as well, because you're essentially, if you're going to take, let's say you're required to take out $6,000, it's at age 72, and you can put in $6,000, contribute. Well, you've just basically and you get a tax deduction for when you put that $6,000 in. So now the income you would have paid on taking out that money is 72, right? You're going to have to, it would go into your income as an RMD, is wiped out by the tax deduction of the $6,000 you put in. So it actually, in some ways, the money that you're taking out as an RMD is almost tax-free. Now, this is just my interpretation of it, but it's an interesting thing to talk about it with your accountant. So contributing money is actually a way maybe to counter the tax impact, a tax hit of an RMD. So just that's my thought. Not new for 2020, but one of my favorite things that my clients very often still don't know about is spousal IRAs. This is where even if the spouse has no earned income, the other spouse can contribute to their own IRA, because IRAs can't be held jointly. That's one thing that's very important. 401k
Right.
plans, IRA,
Right.
can't be held jointly. It has to be in each individual's name. But if one spouse doesn't have the income to contribute all or some of a contribution, the other spouse can contribute. So these are spousal IRAs, which means if one spouse is doing very well or decided to work and one is staying at home or whatever, you basically can still get that double IRA contribution, even though one spouse doesn't have any earned income or not very much.
And the reason you would do that is because you're looking for a higher tax deduction.
You're hired for the tax deduction.
Okay.
Now, this is true for both traditional IRAs and Roth IRAs.
Got it.
And I should back up a little bit that on the RMDs in general, I think I mentioned it, but to make sure, there are no RMDs on Roth IRAs.
Right.
Roth IRAs just go
Right.
tax-free forever. So
Got it.
that's just going back to the previous one. So spousal IRAs, very important and really doubles your IRA potential.
So someone who's on disability and
No.
can't work.
No earned income.
Right. Oh.
That's not earned income.
So
That's
if
passive
if
income.
I was on disability and I couldn't work, my wife couldn't contribute to my IRA.
Yes, she could. I'm sorry. I
She
interrupted
could.
you. I'm sorry.
So
yes.
if
Yes,
interesting.
you could,
okay.
because if she is getting earned income, that's what matters.
Right.
She could push it over onto your side.
Right. I got okay.
Yeah. So this is like, how do you double your IRA? There's a headline,
Yeah.
double your IRA contribution.
Right.
And it's really, very simple.
Right.
Again, this is not new, but it's important. The maximum IRA contribution limits increased in 2019, and that will be again for 2020, to $6,000 for those under age 50, and to $7,000 for those 50 and over. But there's a catch-up contribution for. So that's the new amount. Just FYI, just so people know, that's not that thrilling, but it should be included in here.
So we can put more away.
By the way, something that's interesting on the when they say 7,000 for those 50 and older, a lot of my clients miss the fact that unless we tell them, we try and tell them that it happens the year you turn 50. So it doesn't have to be necessarily just 50. It could be if you turn 50 in August, you can contribute an IRA for the whole year.
Right.
That happens.
Right.
So it's the year you turn 50. The other act that triggered my little compilation of ideas is something I had not heard of either until I came across it. And that is the Taxpayers Certainty and Disaster Tax Relief Act. And this was signed
new to
in,
me too.
Yeah, this was signed in December 20th by Trump. And really what this is sort of a loosening of various things along with the Trump mandate of making government less oppressive and opening up a bit less restrictive. It basically resurrects or extends a number of federal tax breaks. So things that have been taken away, and they're basically saying, no, we're going to actually allow you to keep that for a little more. And some of them are only for 2020. So I'm going to whip through those.
Gotcha.
So the first thing it did, and this gets a little complex, but those who have encountered this will know what I'm talking about. Most people know that when you itemize medical deductions, there is a cap. You have to have a certain amount that you can't take. You have to have a certain amount of adjusted gross income to be able to take medical deductions. Now, this used to be low, and it's gone up over the years. Well, it was scheduled this year to go to 10%. And there's been a lot of talk about that because how many people can qualify for that? I mean, if you make $100,000, you'd have to have $10,000 in medical expenses, and maybe that wouldn't be.
Right. You'd need to be ill.
You'd need to be pretty ill.
Yeah.
So some people still qualify, but anyway, this act pushed it back to 7.5% for 2020 only.
Got it.
So that's just a little perk. If you want to move if you're thinking about getting a medical procedure or something,
Good
you want to
year to
make
do
it this year.
Good year to do it.
Get in there. This Taxpayer Certainty and Disaster Tax Relief Act resurrected the $4,000 federal college tuition write-off for 2020, depending on income. So this has been taken away. Now you can do this $4,000 credit. Basically, it's a credit.
Is that for me or for my children?
Oh, interesting one.
Accountant.
Accountant. That's right. I think it's interesting. I think both. The act also, and this is where they got kind of fun for me, resurrects the $500 credit for energy and efficient home improvements to 2020. So this was the ones where you had to foam insulation or the doors. Or you get that. That's only 2020 again.
Right.
So they're trying to. Everything they're trying to do is jumpstart the economy, but obviously keep the economy strong in an election year. So make no mistake. This one I really liked, and that is that it also resurrects the personal and business federal tax credit for up to 30% of the cost of installing a personal electric vehicle charging station. So we have panels at our house, and we've been toying with, do we want to actually put in like a charging station? And a lot of people are doing it. I don't know about Vermont, but around the rest of the country.
That's what has to happen.
Yeah. So they actually get up to 30% of doing that. So that had been done away with. So they're resurrecting it again. So
they didn't do the 30% back on the panels?
Well.
Oh, wait, something good? Oh, tell me, Todd,
This is your freaky way of asking questions right at the right time. What is going on here?
That's so cool.
Yes.
Yay!
But, not really.
All right.
This is more a reminder. They are not going to allow the 30% credit to remain. So the 30% credit that was up until 2019 for solar panels and inverters and all that is going to lower to 26%.
I know. Those dogs.
Well,
I'm so excited.
Well, the reason is, you don't want the government to just blow money entirely on everything. but solar is holding its own against other energy now. It's become so cheap that they're saying, look, we don't really need the incentives because people are actually choosing solar because it's more cost efficient.
All right.
So, all right. Well, and it gets worse. In 2021, it goes at 22% and then expires.
Right.
So the reason I'm bringing this up is, for our, I can't mention names, of course, but for our friends in the business in this area.
Do it now.
Do it now, and they're saying the same thing because pretty soon it's going to disappear altogether. And this is for residents. For business will still be able to do it.
Of course.
At 10%. But anyway, so this is something to be aware of. If you're going to continue solar, do it now because it's about ready to end. And interestingly, tax credits for hybrid or plug-in cars are still available. They're
really pushing those cars, aren't they?
Well, they're still because that they're still fighting against the gas engines.
Yeah.
It's up to $7,500, but it depends on how many cars have been sold by the company. But I was interesting. I went online to look at, who's left with credits. There's a lot of cars that still give the full $7,500, and there's some that don't. Tesla, some of the others that are more popular are losing that credit. Although I think they had some program to reimburse you even so. But anyway, it's just interesting that even hybrids, it's still available. You should check it out because they're going to wind these down for sure. At some point. And finally, just for fun. I had this one, more fun for people like me. Most people know that you can get a charitable deduction for donating clothes to Goodwill and all that stuff. But there's a new thing in charitable deductions, which is electronics recycling. So if you, or basically donating, electronics donating so they can recycle to all sorts of agencies. And this would be when you donate cell phones, right? You're going to get a cell phone, so throwing it out. Go to I guess Goodwill. I didn't get a chance to find it locally.
Where do we go locally? Yeah,
but I'm sure you can find it out. Cell phones, computers, screens. That's a real. We've taken those things to the dump. Typically, the dump has got a little center where they put that aside. But they're just getting money for recycling. Now you can actually donate it to through charities. So screens, game consoles, all that kind of stuff.
Interesting.
So let's see. And you can qualify for a nonprofit. A nonprofit deduction calculated at its fair market value.
Hey, folks.
Everyone else is asleep.
Thanks for watching us. We'll be back again. And as always, thanks for your help.
Thank you. Appreciate it. Thank you.